One of the hardest things as a long-term real estate investor is making the decision on whether or not it makes sense to actually sell one of your assets. Especially if you've taken time, money, and effort to improve the property, you really don't want to see it go away. I mean, ultimately, you're getting into real estate investing with a long-term belief. If you hold these assets long enough, they'll appreciate, your tenants will pay down the mortgage. So why would you ever want to sell one? Well, that's exactly what we're going to talk about right now. My name is Ryan Richards. I'm a residential loan officer and real estate investor based out of Massachusetts and Rhode Island. This is a conversation I've been having with myself a lot recently, looking at my portfolio, analyzing the equity that I have trapped in the buildings, and comparing it to the performance to see if there might actually be a case for repositioning. So here's some of the key metrics you'll want to know and understand as you evaluate this opportunity. So this is a topic that I've come to learn a lot more about, and something that I think a lot of real estate investors don't really consider or might not put the proper logic to this type of decision. Now, I'm not saying my logic is perfect. There's a million different ways to look at this type of decision. Do you sell and actually relocate to a different property, or do you hold the building that's making you money? It's a hard decision that ultimately requires you to have a very strong sense of the actual numbers for your building. Is it actually performing the way you think it is? If you're considering selling an asset, you need to understand what opportunity you're giving up. If you're selling a property that's a home run and really crushing it in terms of how much money it's bringing in and the appreciation, if you don't know those numbers, then you can't really quantify the potential of selling it. And I see it all the time. Real estate investors, they use the term cash flow very loosely. A lot of investors don't actually know the true performance of their property. Not just the mortgage payment and taxes and insurance, but after all your expenses. What about repairs or maintenance, trash, snow removal, vacancies? Are you really accounting for all of the numbers as you understand your property's performance? So really key point there. Something I've really focused on over the past few months, few years, is having really good bookkeeping. I ultimately hired a bookkeeper to make sure I can keep track of this without me having to do it. I'm not the best at bookkeeping. So I found someone who is. But that's the only way you'll be able to even understand these types of analysis that we're going to go through, is if you understand the numbers of your building. Now, one conversation I had on this exact topic just yesterday, I think will really resonate. I had an investor call me who was looking to go over different financing options for an investment condo he bought a few years ago that he was considering selling or potentially taking cash out of. Now, the problem he had is that the interest rate on his property was exceptionally good. It was an interest rate he acquired during COVID. He was borrowing money at 3% interest. So his natural thought, like many, is why would I ever want to give up that interest rate? I'm never going to get a 3% interest rate again. Doesn't make sense for me to sell and then go take out a new mortgage at 6 or 7%. So initially that sounds like good logic, but the better question to ask yourself is your property performing better than what you could trade into in today's market relative to the amount of equity that you have? So again, back to my point a few minutes earlier, you have to understand what your property's true performance is. Now, let me walk you through this example. So this particular investor, he had a mortgage of about $400,000, and his property now appreciated to be worth about $675,000. So he has $275,000 in trapped equity. At the end of every month, the net amount he was putting into his bank account was $200. Now, that's just on the mortgage. So for round numbers, his mortgage payment was $3,000 a month. He was getting $3,200 a month in rent. So we still haven't accounted for all of those expenses we just mentioned, the repairs, the maintenance, budgeting for capital expenditures. In his mind, his property made him $200 a month. In reality, it probably didn't. But he's so fixated on the fact that he has such a good interest rate, when at the end of the day, I don't really care what interest rate I get, as long as the property performs well enough to cover that interest and still give me the return I'm looking for. Of course, interest rates matter. Of course, I'm particular about the rate that I get and want to get a good one. But whether the rate's 7% or 3% still doesn't affect my metric. I'm concerned with how much income the building is generating after paying the mortgage, whatever mortgage payment that is, relative to the amount of cash I put in the deal. So as long as that bottom line number supports the cash on cash return I'm looking for based on how much I invested, that's the main metric I'm concerned about. Of course, the interest rate influences that, but it's not the key number. So for this particular person, he was making $200 a month. We'll say making in quotations, not actually. But he thought he was making $200 a month. And what he's giving up as an opportunity is $275,000 in equity. So the question I posed to him, right now, your return on that trapped equity is less than 1%. I mean, you're making $200 a month, which is $2,400 a year, against $275,000 in trapped equity. So $2,400 is less than 1% of $275,000. So the question I asked him is, could you take that equity, roll it into another property, and make a better spread? Can you make more than $200 a month on a different building? His answer was, well, yeah, I definitely think I could do that. I could roll it from this condo into a multifamily, outside of the city and collect more rent and really maximize that cash flow. So what that conversation did was just unlock a new frame of thinking. I mean, he was under the impression that this property's gold, it has a 3% interest rate. But at the end of the day, it still comes down to income minus your debt service minus expenses, and what's left over is your profit. And in this case, the profit was very small. Even though the rate was incredibly low, the deal really wasn't performing the way that he had envisioned in his head. So in this case, it actually could make sense to reposition that asset. Sell the property, roll the equity into a building that makes you more money. It's just a hard thing for real estate investors to grasp because nobody likes selling buildings. I personally grapple with this every day with some of my properties. But it's important to go through the exercise and the analysis so that you can understand what options you have and plan for them. Because one piece that's really relevant, of course, is the tax implication if you were to sell. So if you just sell a property that you've owned for many years, you're probably going to have to pay capital gains tax. And that can be 15 or 20% of your total net proceeds. So you want to make sure you plan for that properly. Whether you consider a 1031 exchange where you defer that tax obligation as you roll those into a new property, or you consider potentially offsetting those gains with other losses. Maybe you have cost segregation studies done on other properties to create more losses and offset those gains. There's a lot of different tax strategies you can utilize, but you need to prepare for it and plan early so you can put those proper procedures in place. So that one metric that I would consider is the return on your equity. What's your true net cash flow? Net, after your mortgage, after all your expenses, after a vacancy allocation, budgeting for repairs, budgeting for maintenance, how much is that property really generating you? Once you know that number, compare it to how much equity you have trapped in the property and get that percentage. Is it 5%? Are you making a 5% return on equity? If you have $200,000 in equity in your property and you're getting $10,000 a year in income, that's a 5% return. So the question I would then ask is, could I sell the building, use that equity to go buy a better performing property? That's the fundamental question here. If you take X amount of equity into the market today to buy another building, what can you buy? And what types of numbers could you be looking at? And are they better than the building you have currently? Then you think about tax strategy and avoiding some of those tax implications, which can really change the numbers in this equation. But that's something to think about. And I think the more you go through that analysis, the better off you are to just understand the health of your portfolio and unlock new opportunities. One thing that's also super important as you do this, is there a major capital expenditure coming that you haven't planned for? For example, one of my 5-unit buildings has a septic system. In the next 5 years or so, I'm probably going to have to replace the septic system. So as I run this calculation, whatever my net cash flow is, I'm taking out another $1,000 a month out of my net cash flow. Why? Because if I'm looking at my property's performance over the next 5 years, I have to budget for the fact that I'm going to spend, say, $50,000 on a new septic system. So if I'm running this comparison to see what other properties I could buy that would give me a better return, I have to include the money that I'm going to spend soon on some of these big items. So when I account for items like that, the property doesn't perform as well as I really thought it was, because I'm accounting for future things that haven't happened yet. I'm looking at my true net cash flow, and I'm comparing it to other opportunities. Could I go make more money in a different building? Could I lessen the management oversight by allocating to a different building? If I have a 5-unit that was built in 1900, that was a culmination of a converted schoolhouse with additions, there's a lot of maintenance that happens in those types of buildings. Could I take that and roll it into a smaller building, say a 3-unit, new construction, that has very minimal oversight and maybe higher quality tenants? I mean, these are the types of things that you should be thinking about. Hopefully you found this discussion helpful. Again, there are so many different things to consider here, and everyone's situation is very unique and different, but hopefully this thought process helped you understand how you can start thinking about your next move in your portfolio. As always, thank you for listening, and I hope to see you on the next one.